Hello everyone and welcome to a Glassnode video report for week 6, 2023. So we are looking at the shifting market tides. We've seen obviously a pretty spectacular rally through January. The market is currently consolidating, and as we've talked about over recent weeks, Bitcoin prices really jumped above several key cost bases that we track on chain. And what this really does is it introduces a dynamic of realized and unrealized profit and loss that we haven't seen really because it's been a bear market and everything's been losses. So we're starting to see a bit of a transition towards this realized and unrealized profit. And I want to explore both of these because the concept of realized and unrealized profit and loss are, in my view, some of the most powerful elements in all of on-chain analysis. And it certainly forms the bread and butter of a huge part of my own personal analysis. So I'm really excited to take you through this toolkit and explore what's going on in the shifting tides. So generally speaking, when you come to some of these transitional markets, and I'm thinking like along the lines of 2015 and 2019, it's very rare for a bear market to just end and it all kind of turns around and goes the other direction. Generally speaking, there is this process. I mean, if you look at the 2019 and 20 period, even if a bottom did get put in, we spent another year and a bit trading volatile and sideways all the way from the bottom at 3,200 all the way up to 14,000 and then back down in March 2020 to 3,800. So these processes take a long time for markets to turn around if that is in fact what is going on. So what we're going to look at here is how we can really map out, is this transition really in play? Are we seeing this transfer back into a profit-dominated regime? As the market rallies, more people are going to be holding coins in profit, and therefore people are also going to be able to take profit. So we're going to really explore this from two different angles, primarily the realized profit and loss. When we talk about realized profit and loss, these are coins that people are spending. It's the actualized, somebody accumulated a coin at 16,000 and is now spending it at 23,000. That would lock in a profit. And the guy who bought his coin up at 60,000 and is currently selling down at 23,000 is realizing a loss. Now, the unrealized portion is the other side of that equation. They're coins that have been accumulated, whether higher or lower, and are held to this day. So they haven't actually locked in. It's kind of a paper gain or a paper loss. So we've kind of got four quadrants: realized, unrealized, profit, and loss. And all of these can be used to describe the overall behavior. So we'll look at this in terms of the components, and then we'll also distill these concepts down into a series of macro oscillators, many of which we're starting to return to what is mathematically and statistically a equilibrium point. So we'll talk about this in a second. As usual, before we get started, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And we are going to be continuing with our full-scale chart mode this week. So, and we're also going to be going dark mode. I saw some comments there saying, please go dark mode. So again, we're always iterating, trying to find the right balance. So please let me know if you enjoy this full-scale chart view. And also give me the thumbs up, thumbs down for dark mode. Let's get into it. Okay, so we are going to start very simple with the concept of realized profit. And as you can expect, the next thing we're going to look at is realized loss. So when we talk about realized profit, this really is a bread and butter metric. It's something that I use all the time. This is looking at the US dollar value of a coin that is being spent. So all of the coins moved that day, how many of them were in profit, and how much were they in profit. If somebody acquired their coin at 10,000 and then sold it at 20, and there was equivalent to half a Bitcoin, then they're essentially looking at that $10,000 difference times their half BTC, $5,000 in profit. So it's fairly simple calculation. When was the coin acquired? When was it spent? Check those two prices and then multiply it by the coin value. And then that exercise is performed for the entire market so we can see how much profit the market is locking in. So you can clearly see the bull market stand out. Both 2017 is an enormous, and by the way, this may look exciting. Lots of folks look at these very high peaks and say, look, that's bull market material. Actually, that's people taking profits at the top. And as you can see, we had a multi-year bear market that followed. So very high values of realized profit, like here in January and here in February, are actually signals that coins that were last acquired at much cheaper prices in high volume are actually being spent and likely distributed. So these very high peaks is kind of looking for that counterintuitive view. And also, here's another big note. You can see this massive structural triangle over the last 2 years. Really, the peak profits being locked in was back in the early phase of this bull market. And note that the all-time high we had in October and November, this is a really important concept. This is a big bearish divergence. The market pushed to a higher price, but it was absorbing less profit. There was less demand, even though the price was higher. So the same can be seen if you look at on-chain activity, if you look at MVRV, which is the unrealized profit. There's lots of indicators that had this large structural triangle or a descending line across these two different peaks. We had less momentum, less oomph, less people coming in as demand, less profits being taken, but that was still enough to reverse this thing into a year-long plus bear market. Now, what we can see is a minor uptick of what's going on with our recent push up here in realized profit. This is the highest level it was seen since really June 2022. And this was, even though this was a capitulation style event, we see people actually come in and sell their coins at a profit because they're still panicking. Capitulation can also include profits. We generally see an uptick, but naturally much, much less than what we see during capitulation style events. So it can kind of give you a bit of a gauge that we've seen this large scale compression triangle and we've seen a minor uptick. So this is just something to say, all right, there's more profits in the system, but also let's look at it in terms of scale. It's really back to 2020 levels. It's back to 2017 levels, and prices were much, much lower back then. So we are talking about a substantially lower degree of profit that is currently being locked in. So it's small on a relative scale. So if we now move along and look at the realized losses, this is obviously the other side of the equation, we can see that this has gone through a period where we saw peak losses initially on that first major sell-off in May 2021. So we can see a significant sell-off down here, which actually created that kind of initial impetus and kind of broke the bull market spirit. We then saw that this started to form a plateau with several large-scale capitulation events, both in June 2021, in May, in June, and then again, you can see FTX stand out. So realized loss will tend to peak when you see these enormous flush outs. We can see here again that we have March 2020. We can see that we have the November and December 2018 period. And also note that realized losses are a great indicator when you see a bear market starting. Here we are back in 2018. We saw price fall off that $20,000 peak with some gusto and an enormous uptick in losses. People who bought the top are capitulating out at that point in time. And you can see that this was really the same event that we had back here in May. Now, what you can also see is that this, over recent months and through the FTX disaster, has started to really cool off. So we've seen realized losses start to decline quite significantly. So now we've got a situation where realized profits are up and realized losses are actually down. So we're going to explore this in a ratio now. So this model is the realized PL ratio, or realized profit and loss ratio, and it's literally taking the ratio between how much realized profit is in the system and how much realized loss is in there. We can read this thing in a similar vein to the way we look at popular metrics like SOPR. Very, very similar in the concept, in the sense that when it's down below a value of 1, you have more losses, above more profits, and obviously the larger in scale. Except what this one here is doing is comparing the global USD value in a ratio. Whereas SOPR is looking at a per transaction basis, therefore you're going to have shrimps the same weighting as whales. It's kind of across the whole market. Here we're actually looking at dollar value compared to each other. And you can really see this picks up large scale macro trends, both bulls and then down into bears. You can also see here's that 2017 top. Look at the massive and dramatic decline from the top. We went from a all is well, happy days, profit time to a very, very quick and sharp move down into losses. So really that sharp move down, we can see it here in 2013 on both peaks, and we can see it, in fact, you can even see this declining as we came up over the top here in this February through to May peak in 2021. What we will just do, I'm just going to grab this, the exponential moving average here, and just put it on a 30-day. Just really take some of the noise out of it, and you can really start to see those dramatic declines. So you can see where this 2017 peak came in. You can see where the May peak came in. Typically, these structural declines of dramatic scale indicate that we have transitioned into a new regime. Now, let's put that into the opposite light. We're now looking at this from a bear market perspective. So if a large, sharp decline in overall profits means that we are likely transitioning towards a bear market, then these very sharp upticks off the bottom, and we move back into profitable territory, typically after a long and sustained period where everyone is just getting locked in losses. Here, we're seeing a massive push higher where realized profits are now starting to dominate. So it's kind of one indicator that we may well be moving back into a regime where people were able to realize profits. There is a bit of demand coming in to actually absorb that profit taking. And as I've said in previous videos, and maybe your experience is different to mine, but I very rarely hear my friends come in and say, hey, I'm having so much fun losing money in this market. It typically is the other way around. So generally speaking, assets tend to get into a bit of a cycle. That's why we literally have cycles. So this is at the very least an early sign that we are now in a regime where profits are being realized more than losses. But remember, it's not clear sailing. Here we are in 2015, we had an entire year of chopping sideways. So in many ways, this has a lot of semblances to the 2015 era, which was 12 months of just sideways pain. And then the 2019 era, which was euphoria, followed by another 12 months of sideways pain, and then the March 2020 event. So it is not a clean sailing here. We are just looking at the turning of the tides, but these things tend to take time, at least based on the few data points that we have through history. Now, putting a lot of those ideas together, and this is actually a workbench chart. So under workbench, you will find that we have a whole suite of these pre-built customized sets here. So these ones are under the profit and loss category. And for these ones here, I've actually changed and put a 7-day moving average on there. You'll see here with the profits, it can be quite noisy if we're looking at it on the daily basis. So sometimes I like to just put a 7-day moving average on the realized profit and realized loss, and we can just see the overall picture of this thing. So what we're basically doing is taking that realized profit and realized loss, putting them together on the same chart where one is positive, one is negative, and we can see the FTX flush out. We can see the June flush out. We can see the Lunar flush out. You can see these major capitulation events stand out quite clearly, and they generally precede some kind of market reversal or at the very least some kind of consolidation. So these large flush out events typically signify a bit of a regime change themselves. Same as market tops. These large peaks in profits typically signify that there is something starting to change. Here's the October-November peaks. Something is starting to change when you get lots of people taking profits. It means you need more people coming in and more demand. And if the demand isn't backed up by on-chain activity or many other metrics we can kind of measure this by, yeah, you start to say maybe it doesn't quite have the legs. Now, where we are at the moment, here's where we can see that our profits have ticked higher than our losses. That's the first observation. We've seen this in our net and the PL ratio. But the other thing I want you to take home here is when you look at this chart, the scale of these two is really not the thing that stands out. They're pretty small in a relative scale. So really, it doesn't really look like either a bull or a bear market, which again gives us that indication that perhaps it's a bit more of a sideways, choppy, boring, transitional period. Again, we can always observe this data as it plays out, and we can start to look for signs that maybe there's more losses starting to creep back in, and that would indicate the top buyers are getting out. Or we see more and more profits, which says people are taking a bit of a cautious view and starting to exit. So again, it's all about looking at the rate of change. How do these metrics transform over time, and what does that tell us about investor sentiment? Now, I mentioned that they're fairly small in terms of total realized profit and loss, and that is true. What we're looking at here is another workbench preset. This one here you will find under market indicators called the sell side risk ratio. And the next one we're going to look at is the realized RVT ratio. These are both using the same concept. We've got an amount of realized profit and loss, but how big is that relative to the market? Is that a large amount compared to how large Bitcoin is? So what the sell side risk ratio is looking at is how big is Bitcoin? Right? How large is the asset? And we measure this via the realized cap. Then what we're saying is how much profit and loss have we got? The total dollars that are, kind of think about this like the payload. How much is actually being locked in by the market in either profit or losses? So let's say we have $1 million in profit and loss combined, but the market size is 400 billion. Then that million, it's probably big to you and I, but it's nothing compared to the size of Bitcoin. That will return a very, very low value. So typically we see these low values in quiet, low volatility, not much going on. Post FTX, just before FTX, FTX was not one of those events. We had a large payload relative to the market. And then afterwards, we went for a very, very quiet December. We saw this right before the November sell-off in 2018. We also saw it right before the rally upwards. So this is not telling us anything about direction. It's telling us when does the market go to sleep. There's not much happening relative to market size. So it typically signifies that we're at a bit of a transitional point, and that can be in both directions. But typically low volatility, back here in 2015, low volatility tends to precede high volatility, and high volatility creates more realized profits and more realized losses. So this is a bit of a looking forward. How large is the current realized value relative to the size? If it's not much, it's a low volatility, quite quiet environment. Generally speaking, that precedes a period of much higher volatility. Now, that previous metric was comparing the realized value to the market size, right? How big is it relative to Bitcoin's realized cap? Well, we can also look at this in the sense of how big is it relative to the transaction volume. So there's an amount of value flowing through the system. Imagine a day where you've got, 1,000 Bitcoin that are on the move, and each one was last acquired $1 at $1 at a cheaper price. The amount of transaction volume is 10 BTC, or 1,000 BTC, sorry. But they may be realizing like $10 worth of realized profit and loss, which is like, who cares? $10 distributed over 1,000 BTC, it's kind of small. But what happens if those 1,000 BTC were Satoshis and they were locking in a profit from way back where we didn't even have a price, and they're currently locking in an enormous profit or an enormous loss? So this model is essentially comparing the realized profit and loss to the transaction volume. High values means that you have a huge amount of that happening. Again, cycle transition points. Here in February or January 2021 really was the peak in a great many metrics. It kind of showed that's where we saw the massive expulsion of all of the transactions. FTX, also one of these events. November 2018, one of these events. March 2020, one of these events. This model really helps us find periods of extremely low volatility and extremely high volatility. And when you see these extreme points, they also tend to correlate around a shift in psychology. People get completely blown out during a capitulation event, and then the dust settles and things are a little bit better and things start to get into a more healthy system. Or at market tops, you see stacks of people selling all of their coins, taking enormous profits. That first sell-off comes and you get just a flush out, a complete wipeout, and the bull market psychology is taken out the back. So what you start to see is these turning points come with low and high volatility, and these two tools can help you try and identify those big picture macro turning points based on these high and low elements. And by the way, all of these have very, very robust descriptions for them. And again, if you have any questions whatsoever, you can always ask me in the comments or anywhere that you can find me. Okay, so now we're going to move on and look at some cyclical momentum oscillators and just kind of where the market is. And, how do we tell whether we've returned to some kind of equilibrium? What does a turning point look like? So the model that we're looking at here is looking at the unrealized profit. Think about this. At a bull market peak, everyone's in profit. Every coin that they're holding at the all-time high, everyone's in the green. At a bear market, it's the exact opposite. There's basically no one left who's in the green. Now, what happens is when you get to late stage bear markets, as we can see back here in 2015 and 2018, we typically get these big rounded bottoms. And what happens here? Price really towards bear markets 2015, it was 1 year of just chopping sideways. Here back in November, December 2018, we chopped sideways for like 6 months. Back here, post the June event, I'm going to use that as our baseline, including the FTX. We essentially went from June all the way through to January. So it's like 7-8 months where we just went sideways and did nothing. During those bottoms, top buyers are capitulating out. They are selling, they're distributing, get me out of this thing. Their unrealized profit gets locked in, their unrealized value becomes a realized loss. I'm taking the L, I'm out of this system. Someone else bought those coins. And then price goes $1 or a cent above their acquisition price, they are now in an unrealized profit. So what we see is that during those big scale accumulation periods, this metric will start to reverse and form this nice rounded bottom. Especially, look at 2015, sideways in terms of price, but curling upwards. More and more people were coming back into a profit, even though price didn't go anywhere. Back here in 2018, price went from like 3.2K to 4K. And look how many more people started coming into profit. The momentum of profit was climbing. Here we are. Here's June. So even including the FTX, we saw that even though price went sideways to down, more and more people were returning to profit. And then what you'll also note is these very violent explosions back to the upside following each of these bears. These are these cycle turning points. It's showing that we're getting back into some kind of regime that at the very least, it doesn't have the same characteristics or properties as what we saw back in the previous bear market. And this is driven by the fact that coins have changed hands. There is a new ownership structure. New people hold the asset, and the people who were going to capitulate have capitulated. And you're now into this situation where psychologically, financially, behaviorally, it's a different space, and we therefore have to start thinking about things from a slightly different lens. Now, we also have a really neat tool here called time below current value. So what we're doing here is saying, okay, what is an equilibrium level? Because you can see by the red line, it kind of visually looks like it's in the middle. But we can actually mathematically show this, that 54.5% of all trading days have seen a lower value. So, 5% between friends, who really cares? We're about halfway. We're pretty much in the middle. This is the line where, typically speaking, bear markets spend their time below it, bull markets spend their time above it. So we are literally at that equilibrium point. Now, remember, as I said earlier on, all this is telling us is that the regime looks like it's changing. This was the same regime as 2015, which was a year of painful sideways chop. This was 2019. A rally into another year of painful sideways downwards, and then March 2020. So it is not telling us that the bull market is back. All it's telling us is there has been a change of ownership structure, and therefore it makes sense to pay attention to these markets as potentially in a transitional period, right? So when we're looking at this compared to previous cycles, investor psychology is a bit different. The ownership structure is different. It's different. It looks different to 2022, and therefore we can kind of start looking at things with that in mind. Now, on a very similar model, we have here the adjusted reserve risk model. So this one here is very, very similar in concept, except it will trend higher when hodlers are spending and trend lower when hodlers are hodling. Now, it may surprise you, but during bull markets, hodlers are actually the ones who are doing all the distribution and the selling, because they're acquiring coins in the bear market. They're sitting tight for years on end. And then when the bull market finally comes around, they start distributing. So this particular model, higher values basically indicate that the smart money is starting to distribute. Low values is the opposite. They're actually saying, well, I'm willing to weather this pain and this volatility and this downside because I believe in this asset. So low values typically signify that you've got more hodling going on. And like previous cycles, you'll see that this rapidly declines. Following bull market peaks, in fact, look at this. Look at the November to October. Talk about a bearish divergence. This thing didn't even show up. So it just again shows you that this whole thing, when we come to the October-November event, really just didn't have any legs whatsoever. Now you can also see the blue curve. We're pretty much dead smack in the center of the line that defines bear markets. 2019 poked its head up, but it wasn't ready, pulled back down into bear market territory. We can see here all of 2015 was testing and testing and testing, and it was only that final rally near the start or near the back end of 2015 that kind of pushed us above. And then we moved into a second phase of accumulation and uncertainty. So here we are poking our head up against this middle level where 54% of all trading days have been below. So again, we have pretty much returned to an equilibrium level where half the market is seeing days below this and half the market is seeing days above. So overall, it really looks like a transitional period. The psychology has probably changed compared to 2022. Certainly the ownership structure of coins appears to have changed. There's been a combination of realized losses, which becomes somebody else's realized profit. And this is just how cycles move. It's just kind of nice that with Bitcoin, we can actually visualize and look at these things in almost real time. So thanks everyone for tuning in. Hopefully you enjoyed that session. That was a bit of an interesting gauge on how quickly things can start to move and start to transition towards a new psychological regime. Now, I really do encourage you. We have rolled out a realized profit and loss dashboard. This thing contains pretty much all the metrics that we covered today. So I do recommend checking that one out. It will be in the description below. This is one that I use all the time. And we also have an unrealized profit and loss. So if you're looking to learn either of those two, do check the description below, and I will see you in the next one. Cheers.